If you or someone you know is having financial troubles with their home, this video is about how hard money loans work. Now, there are two types of hard money loans. There are hard money loans that investors use to fix and flip homes with, and then there are hard money loans for people in financial trouble. Basically, people who don't have good credit that need to borrow against their home. So for example, let's say you are in foreclosure or pre-foreclosure, you might consider using a hard money loan. Or let's say you inherited a property that needs a lot of work and you need to borrow some money to fix the home up so that you can sell it. Or instead, maybe you inherited that property with a bunch of other family members and you need to borrow some money to buy each of those family members out. You might consider a hard money loan. Facing a divorce or getting your grandmother out of that reverse mortgage she took out on the family home. These are all good reasons why people use hard money loans. Now, the first thing you need to know about a hard money loan, they are very expensive. For example, right now, regular interest rates to buy a home are around 7%. Well, compare that to hard money interest rates, which start at 10% and can be as high as 16%, or maybe even higher. I don't know. 16 is the highest that I've ever seen. In addition to the high interest rates, you also have to pay upfront fees, which are called points. 1 point is equal to 1% of the loan amount. The average points on hard money loan ranges between 3 to 10% depending on your scenario. Again, the points are paid up front, so you might be thinking, well, if I need to borrow money in the first place, I clearly don't have any money to pay any upfront fees, which to that I say, it's not a problem because the points you pay can come out of the loan amount. So for example, let's say you're borrowing $100,000 and the points being charged are say 10, which is $10,000 in this case. You will net $90,000 and the $10,000 fees will come out of the $100,000 loan amount. Now, the last thing to know about hard money loans is that the monthly payments you make are interest only, meaning that every month you make a payment, the amount you borrowed never decreases. So let's say you borrow $100,000 at a 14% interest rate. Your monthly payment is $1,166.67. For every month you make a payment, the balance never decreases, and say you have the loan for a year. At the end of that year, you still have to pay back the full $100,000 that you borrowed. Basically, hard money loans are for people who are going to either sell the home at the end of the loan term to pay off the loan, or for people who know that they're going to come across a large amount of money in the future, or will have the ability to refinance out of the hard money loan to pay off the loan. So if you or someone you know is going through financial hardship with their property here in Southern California, send them this video and give me a call so I can help you figure it out.